It's official. No doc funding is absolutely cooked. This article came out yesterday. JP Morgan Chase to adopt cash flow underwriting. JP Morgan Chase will use cash flow underwriting. The New York bank, which has about 80 million customers and $18 billion technology budget, will soon deploy Nova Credit's Cash Atlas software, automates cash flow based underwriting. The software lets banks evaluate a potential borrower's credit worthiness by analyzing how that person has been managing the money in their bank accounts, replacing or augmenting traditional criteria like FICO scores and credit bureau reports. Cash Atlas also can be used to monitor for signs of trouble or an opportunity to upgrade a product. Now, what exactly does this mean? This means that a lot of these credit hacks like authorized users, trade lines, even credit repair might soon become obsolete or less effective because now you have cash flow based underwriting. This is going to look at banking activity. I've talked about this for years, how the traditional underwriting systems are changing. In the past, a lot of institutions have utilized credit scores. Credit scores are backwards looking. There could be a customer that might have current financial trouble, but if you're looking at their credit, which shows their past performance, that might not let underwriters and banks know what their current financial position is. So they could have lost a job, their income could have went down. So this is a more accurate depiction of current financial status. Chase is committed to being the bank for all, and tools like Cash Atlas and Credit Passport will help this mission by giving a more comprehensive view into each individual and their credit needs. With this new data source, we can better assess the credit risk, make more informed lending decisions, and approve customers with right-sized lines of credit. Cash Atlas Cash Flow Analytics aims to paint a picture of a consumer's financial health through trended data on income, expenses, and assets. Other vendors like Prism Data, Experian, and Plaid also provide cash flow analytics to banks to help with credit decision. Now, I was actually on a call last fall with Plaid and Prism Data, where they were basically saying by around 2030, nearly 80% of all U.S. financial institutions will have some form of cash flow based underwriting integrated in their underwriting processes. So basically what that means is that they want to know how much money you actually have flowing through your accounts. The whole point of cash flow based underwriting is to have better risk assessment. As I was saying, credit is backwards looking. It's past performance. It's not current performance. Banks are starting to care less about what you did in the past and more about what you're doing right now. I know a lot of people rely on no doc credit funding programs to get access to credit. And most of the time it's because you don't have the current income. So if it's no docs, that means they're going to be relying on your credit. If you have a high credit score, maybe some trade lines or primary accounts, then it could appear as though you're more credit worthy than you actually are. Now, one of the main drivers behind this cash flow based underwriting push is so banks have better risk assessment. Instead of just relying on what you did in the past, they can see what's going on right now. Traditional loan underwriting systems rely heavily on FICO scores and a few other criteria like debt to income. These tend to decline or offer only high-priced credit to young people, immigrants, and people who haven't borrowed in the past, and people who have had temporary setbacks. Cash flow underwriting is not a new concept, but it is gaining momentum. Traditional credit evaluation methods, while historically reliable, struggle to capture the complete financial picture of modern customers. A survey of 150 U.S. consumer lenders found that 58% are less confident about making consumer lending decisions based on traditional credit files and scores than they were a year ago. Credit restoration, credit repair, where items could get removed off the credit file. So you could have someone who defaulted on all their loans and credit cards, get these items taken off, get a bunch of new accounts, authorized users added to their account, and now all of a sudden they went from a 500 credit score to a 750 or 800 credit score. That doesn't necessarily mean that their risk assessment has changed. So this is actually a reason why lenders are pushing now for cash flow underwriting. They're aware that credit scores can be manipulated. Another big reason behind this is because you have a lot of these no-doc loan programs which are seeing high defaults. And Chase, being the largest bank, recently started to cut back on their no-doc credit cards. So a lot of you guys have probably seen, oh, run the Chase play, or you get $75,000 from Chase. I could tell you, I've seen a lot of these credit reports where people got these business credit cards, 75,000, 50, 60,000, defaulted on those in less than a year, and then got those accounts removed off their credit reports. Banks really want to see a more accurate depiction of your current financial situation. Now, what better way to understand your current financial situation is to see how much money is actually in your bank account. You can manipulate credit scores, but you can't manipulate that bank balance. A study published in June found that cash flow data can help lenders underwrite small businesses more accurately, particularly when evaluating early stage companies and financially constrained entrepreneurs. The analysis found that cash flow variables derived from bank data provided a stronger and more accurate basis for predicting loan performance than the business owner's personal credit scores alone, especially for businesses that are relatively new or have owners with low credit scores. The time frame of bank account data, also known as the look-back window, is configurable and can range from 3 to 24 months. The mindset behind traditional credit decisions and the basic idea behind the FICO score is that the best way to predict whether a consumer will be able to repay a loan is to look at whether they have repaid loans in the past. It's true that someone's demonstrated ability to have repaid loans in the past is important in predicting their future likelihood, but it can miss certain information disproportionately for certain population. With cash flow data, you're seeing the actual transactions and therefore can make judgments about someone's ability and capacity to manage credit in real time, as opposed to having a lagging indicator. Now, I've been telling you guys for years, back in 2020, about Plaid, cash flow based underwriting. Now you have a lot of other fintechs now that are looking at payroll data. They're looking at tax information. And so while credit scores have traditionally been used to assess risk, banks understand that there are flaws in the FICO system. There are a lot of defaults across the credit spectrum, not just people with low credit scores, but even people with these inflated 750, 780, 800 credit scores. Because as you know, a lot of these no-doc programs, people will qualify based on a high credit score, but since they're not providing any financial data as far as their income, and banks are now seeing a lot of defaults there, they're wondering, okay, does this 750 or 800 credit score really mean anything if we're not also verifying how much money they have to service the debt? A lot of these no-doc programs are going to go away. Chase Bank, being the largest bank in the United States, is making this first big push, and a lot of other smaller banks are going to follow right behind them with integrating cash flow based underwriting. Cash flow based underwriting is going to reduce the risk for a lot of lenders. Just because you have a high credit score doesn't really mean that you have the ability to repay if you don't have any income coming in. You could be unemployed with an 800 credit score. On the other hand, you could also have a 550 credit score and generate a lot of income. I've seen that a lot where you might have business owners, they're generating, a lot of money, but they can't get traditional credit products because their credit score is too low because of a collection from 5 or 6 years ago. Now they have a derogatory item, and despite having the income, they can't qualify based off of credit. So I think that's going to open more opportunities for those situations. But a lot of people out here who don't have verifiable income, is going to be a real struggle, even if you have authorized user trade lines, primaries. Soon, that's not even going to matter because they're going to say, look, we don't care about your FICO score. Show me how much money you have coming in and out of your checking account. Now, cash flow based underwriting is something I think also is being pushed because we're seeing record consumer debt, record defaults, where a lot of those defaults are based off of credit score decisions. And you have a record amount of fraud. You have a lot of people trying to run the play, running off on these banks, and they see what's going on. They look online, they see people are able to get their credit repaired, add trade lines, add primaries, and then go run it up at the banks and run off. I actually used to work with a partner where they did a soft pull only approval. And what they saw was it didn't matter what credit score people were at. You had people at the higher end of the spectrum where they would get approved based only on their credit score and then never make one payment. And so they were always wondering, why are these higher credit score applicants not even making a single payment? Cash flow based underwriting is going to mitigate all that. A lot of these plays you see, all this no-doc marketing, that's going to go away real quick. Chase is going to be leading the way, and all the other banks are going to follow suit. So no-doc funding is absolutely cooked. You need to document your income and have verifiable financial documents. A lot of people get mad at me when I tell you what's coming, how to navigate this whole banking system to still get access to finances. And I'm telling y'all right now, you're going to see the majority of financial institutions adopting cash flow based underwriting. So if you don't have money flowing through your accounts, you're going to be cut off from a lot of these financial products. Yes, credit traditionally has opened the doors, but going forward, banks want to know a little bit more. They want to see, do you actually have money coming in? Has anything materially changed about your financial situation? For example, let's say if you have an 800 credit score and maybe you have $100,000 in credit card available limits, right? If you lose your job, your credit is not going to deteriorate maybe for 6 months, a year. So it doesn't really give the best picture of what is currently going on in your financial situation. Remember, credit is backwards looking. It's a lagging indicator. Cash flow based underwriting is what's going on now. So I wanted to let y'all know Chase is now doing cash flow based underwriting. They're adopting this, and we're going to see this at a lot of other banks. Make sure you understand this going forward. I see a lot of people trying to apply these old tactics, old hacks to try to get money from the bank. And from what I've started to see, I get messages all the time. It's not working the same way it worked 5 years ago. So you have to adapt to the changing times. Banks have access to artificial intelligence. So they have so much data at their disposal to assess you for risk. And it's only going to be more data driven going forward. So that's all for today's video. Let me know your questions down below. Until next time, take it easy and we'll talk to you soon.